There is a moment in every major financial crisis that historians call the Wile E. Coyote moment. It is that split second when the market has already run off the cliff, but gravity hasn't realized it yet. The legs are still spinning, the price charts are still hovering in midair, and the commentators are still talking about a soft landing. But if you look down, there is no ground beneath your feet. Yesterday afternoon, the United States government just looked down. While you were likely distracted by the endless noise of the culture wars or the latest viral debate, the Supreme Court of the United States quietly delivered a verdict that has effectively severed the safety rope holding the modern economy together. In a ruling that strips the executive branch of its emergency economic powers, the court didn't just block a policy, they crushed the entire operating system of the White House. They told the president that the tool he has been using to manage the economy, the ability to unilaterally impose tariffs, redirect funds, and rewrite trade rules, is illegal. Crushed is not hyperbole. It is a legal description of what happens when a constitutional hammer comes down on an executive glass house. The power to manipulate the economy by decree is gone. And with it, the Trump trade, the betting on deregulation and aggressive protectionism, has turned from a guaranteed win into a catastrophic liability. And you might be thinking, the market is only down 1% or 2%. Why the alarm? Because you are looking at the noise. You need to look at the signal. And the loudest signal in the world right now isn't coming from Washington. It is coming from Omaha, Nebraska. Warren Buffett, the most patient investor in history, is not buying this dip. He is not being greedy when others are fearful. He is selling. He is selling with a speed and aggression we haven't seen in 20 years. New filings reveal that Berkshire Hathaway has now amassed a cash pile of nearly $382 billion. Let that number sink in. That is more than the GDP of most nations. That is more cash than Apple, Google, and Microsoft hold combined. Why would the world's greatest investor hold that much cash in an environment where inflation is supposed to be eating it away? Why would he sell billions of dollars in Apple and Bank of America stock while the news anchors tell you everything is fine? Because he saw the law coming. He understood what the rest of the market is just now figuring out. The era of the imperial president, the era where the White House could bail out any industry and print infinite money, ended yesterday. Buffett isn't panicking in the emotional sense. He doesn't scream. He doesn't cry. In the world of high finance, panic looks like silence. It looks like exiting the building before the fire alarm even rings. It looks like $382 billion sitting in short-term treasury bills because you don't trust a single stock certificate to hold its value when the government loses its power. Today, we are going to walk you through the debris field. We are going to explain exactly what law was crushed, why it breaks the business model of the American economy, and why Warren Buffett's panic is the only rational response to a world where the rules of money have just been rewritten overnight. To understand why this ruling is an extinction-level event for certain portfolios, we have to strip away the politics and look at the plumbing. We need to talk about a boring, dusty law from 1977 called the International Emergency Economic Powers Act, or IEPA. For the last 50 years, this law was the president's magic wand. It was designed to let the president sanction terrorists, freeze the assets of rogue dictators, and respond to national security threats. It was a wartime tool, but over the last decade, and accelerating aggressively in this administration, that wartime tool became an economic multi-tool. Presidents realized they could declare a national emergency over anything. Trade deficits, emergency. Immigration, emergency. Supply chains, emergency. Once they declared the emergency, IEPA allowed them to slap tariffs on foreign goods, seize assets, and rewrite contracts without asking Congress for permission. It was the ultimate cheat code. If the economy was slowing down, the president could just wave the wand, slap a tariff on China or Mexico, and tell American factories, "I saved you." It created an artificial stability. It allowed the White House to micromanage the S&P 500. Yesterday, the Supreme Court took the wand away. In a landmark decision, the court ruled that trade imbalances are not national emergencies under the definition of the law. They ruled that the president cannot use EPA to rewrite the tax code or impose broad tariffs just because he thinks it's a good idea. They cited the major questions doctrine, which basically says, if a decision affects trillions of dollars, Congress has to vote on it. One man cannot decide it. This sounds like a victory for democracy, and in a civics class it is. But in the financial markets, it is a disaster. Why? Because the market has priced in trillions of dollars of revenue based on those emergency tariffs. Think about the steel industry. They are profitable because foreign steel is taxed at 25% under IEEPA. Think about the solar industry. They are alive because cheap Chinese panels are blocked by IEEPA. Think about the tech sector. They are protected from foreign IP theft by threats of IEEPA sanctions. The court just said those protections are illegal. They are null and void. This means the moat around the American economy, the artificial wall that kept prices high and profits safe, has just been breached. Without IEEPA, the president has to ask Congress to pass a tariff bill. And have you seen Congress lately? They can't agree on a lunch order. The idea that they will quickly pass a complex trade protection bill to save these industries is a fantasy. Buffett understood this mechanism. He knows that American corporate profits have been inflated by this protectionism. When you strip away the protection, you strip away the profit margin. The panic you are seeing in the bond market, with yields spiking, is the realization that the manager of the economy has been fired. The White House is no longer the CEO of the GDP. They are just a spectator. And markets hate spectators. They want a captain. The Supreme Court just threw the captain overboard. Let's move from the Supreme Court to your wallet. I want you to visualize exactly how this legal ruling travels from a piece of paper in Washington, D.C. to the price of goods in your local store. Imagine you are the owner of a mid-sized electronics company in Texas. You make components for smart homes. You employ 150 people. For the last 2 years, you have been operating under the protection of Section 301 and IEEPA tariffs. These laws made your Chinese competitors 25% more expensive than you. That 25% gap was your profit margin. It was the reason you could pay your workers $25 an hour. It was the reason you just took out a $5 million loan to expand your factory. You felt safe. You listened to the president say, "We will protect American industry." You believed him because he had the power to do it. Yesterday at 2 p.m., your phone buzzed. It was your supplier in Shenzhen. The text read, "Tariffs illegal, new pricing attached." You open the attachment. Their price just dropped 20% overnight. Suddenly, your American-made product is overpriced. Your inventory is depreciating on the shelf. The $5 million loan you just signed, it is backed by revenue projections that are now mathematically impossible to hit. You have 3 choices, and they are all fatal. Slash prices. You match the Chinese price. But to do that, you have to cut wages by 40%. Your best workers leave. Quality drops. You die a slow death. Lobby Congress. You fly to Washington to beg for a new law. You spend months in meetings. Meanwhile, your market share evaporates. Liquidate. You realize the game is rigged against you again. You sell the inventory for pennies on the dollar, fire everyone, and close the doors. Now, multiply your story by 50,000 businesses. Steel mills in Pennsylvania, solar installers in Arizona, aluminum plants in Kentucky. This is the supply chain nightmare that the market hasn't priced in yet. The algorithms are still looking at last quarter's earnings. They aren't looking at next month's competition. And it gets worse. Think about the revenue side for the government. Those tariffs weren't just protection, they were taxes. The US government collected billions of dollars in tariff revenue. That money was used to lower the deficit, or at least pretend to. With the Supreme Court striking down these tariffs as illegal, there is a terrifying legal question that nobody wants to answer. Does the government have to pay the money back? If companies sue, and they will, to get a refund on the illegal tariffs they paid for the last 4 years, we are talking about a potential liability of hundreds of billions of dollars. The US Treasury could be on the hook for the biggest tax refund in history at a time when we are already running a $2 trillion deficit. Buffett sees this. He looks at the US government's balance sheet and sees a liability that isn't listed. He sees a government that might have to print another $1 trillion just to pay for its legal mistakes. And what does printing money do? It destroys the value of the dollar. So Buffett sells stocks, which need a strong economy, and buys short-term treasuries, which are the only thing that gets paid first. He is insulating himself from the U simulation. He is making sure that when your business faces that nightmare choice, he is the one holding the cash to buy your distressed assets for pennies. Here is the twist that the mainstream media is completely missing. They are treating this as a political loss for the president. Oh, the president is embarrassed. Who cares about embarrassment? We care about solvency. The twist is the refund crisis. When a law is declared unconstitutional or illegal, it is as if it never existed. This is a principle in law called void ab initio. For years, importers have been paying these IEEPA tariffs under protest. They have filed thousands of lawsuits in the Court of International Trade, keeping the receipts, waiting for this exact moment. Now that the Supreme Court has ruled, those importers are going to demand their money back, plus interest. Let's play this out. Walmart, Target, Best Buy, Ford, GM. These companies paid billions in tariffs on parts and goods. They passed some of those costs to you, but they absorbed a lot of them. Now they have a legal claim to get that money back from the Treasury. If the Treasury has to write a check for $300 billion or $400 billion in refunds, where does that money come from? It doesn't exist. It has already been spent. It was spent on fighter jets, Social Security, and interest on the debt. So the government has two options: raise taxes. Impossible. Congress won't pass it. Print the money. The Federal Reserve has to create new digits to pay off the legal judgment. This is an inflationary nuclear bomb. Just as the Fed was getting inflation under control, the Supreme Court might have just forced an injection of $500 billion of new liquidity into the system, not as stimulus, but as legal restitution. This is why Warren Buffett is panicking into cash. He knows that cash is trash in an inflationary environment unless that cash is deployed at the absolute bottom of a crash. But wait, there is a deeper layer to this twist. If the government has to print money to pay refunds, bond yields will skyrocket. Investors will demand a higher return to hold U.S. debt because the U.S. balance sheet looks like a disaster zone. When bond yields rise, stock prices fall. It is a mechanical relationship. High rates crush PE ratios. Buffett is looking at the S&P 500 trading at 22 times earnings and saying, this valuation assumes 4% interest rates, but if the refund crisis hits, rates are going to 6% or 7%. At 7% interest, the fair value of the S&P 500 isn't 6,000, it's 4,000. That is a 33% crash. That is the math behind the panic. It isn't emotion. It is a discounted cash flow analysis that includes a variable everyone else left out: the Supreme Court's invoice. Most investors are playing checkers. They think, tariffs gone, cheaper goods, good for economy. Buffett is playing 4D chess. He thinks, tariffs gone, char's government liability, char's money printing, char higher rates, char's stock market crash. He is 12 moves ahead, and he has $382 billion waiting for move number 13. To truly grasp the gravity of this moment, we have to look back. History doesn't repeat, but it rhymes. And right now, it is rhyming with 1952. The Korean War was raging. The U.S. needed steel. The steel workers threatened to strike. President Harry Truman, a man who believed in the absolute power of the office during wartime, issued Executive Order 10340. He seized the steel mills. He nationalized them. He said, I am the commander-in-chief, and I need steel. It was a bold, popular move. It ensured production. It felt like leadership. But the Supreme Court said no. In Youngstown Sheet and Tube Comer v. Sawyer, the court ruled that the president cannot make law. He can only execute it. They ordered him to give the mills back. What happened next is the part the history books often skip, but the economics books remember. Chaos. The strike happened. Steel prices spiked. The economy wobbled. Defense production slowed down. The certainty of the strongman was replaced by the uncertainty of the free market. We are living through the Youngstown moment of the 21st century. The difference is, in 1952, the U.S. was the undisputed factory of the world. We had a trade surplus. We had low debt. We could afford a mess. Today, we are a debtor nation. We have a trade deficit. We rely on the kindness of strangers to buy our bonds. When the Supreme Court tells the world, the president cannot guarantee the rules of trade, they are telling foreign investors, your money is not safe here. If you are a Japanese pension fund or a Saudi sovereign wealth fund, you invested in the U.S. because of stability. You thought the president could protect your investment. Now you know he can't. What do? You sell. This is the capital flight risk. Buffett sees this too. He knows that if foreign capital starts leaving the US because of legal uncertainty, the dollar weakens and import prices soar. It creates a vicious cycle. Court strikes down tariffs. Foreign capital gets scared of instability. Dollar weakens. Imports get expensive. Even without tariffs. Inflation rises. The Fed hikes rates. The economy crashes. Buffett's cash pile is his bunker against this cycle. He is holding short-term treasuries because they mature quickly. He isn't locking his money away for 30 years. He wants liquidity now because he expects the opportunity of a lifetime to appear in the next 12 to 18 months. He knows that after the Youngstown chaos, the market eventually found a bottom and rallied. But you had to survive the chaos first. Most retail investors are fully invested. They have no cash. They have no bunker. They are standing in the middle of the steel mill floor, waiting for the roof to collapse, arguing about whether the roof is red or blue. Buffett is outside, watching the foundation crack. Let's look at the specifics. Buffett panics is a great headline, but Buffett reallocates is the profitable lesson. What is he actually selling, and what does it tell us about the law-crushed White House thesis? 1. He sold Apple, technology, consumer goods. Apple is the ultimate global supply chain company. It relies on seamless trade between China, Vietnam, India, and the US. It relies on a stable regulatory environment. If the Supreme Court ruling creates trade chaos, supply chain disruptions, or retaliatory moves from China, who might smell weakness, Apple is in the crosshairs. Buffett selling half his stake isn't a lack of faith in the iPhone. It is a lack of faith in the geopolitical stability required to sell iPhones. He is telling us, the global trade system is breaking. I'm out. 2. He sold Bank of America. Financials. Banks are leveraged bets on the US economy. If the economy grows, banks win. If the economy stagnates or faces a refund crisis, banks suffer. But more importantly, banks hold US debt. If the refund crisis forces yields up, the value of the bonds held by banks goes down. Remember Silicon Valley Bank? They collapsed because yields went up. Buffett sees the risk of a sovereign debt crisis triggered by this legal paralysis. He is reducing his exposure to the banking system because he knows the banks are holding the bag for the government's mistakes. 3. He is keeping insurance. Geico, General Re. Why? Because insurance is a float business. He gets the cash up front and pays claims later. In a high-interest rate environment, which this crisis creates, that float earns massive returns. Also, people need insurance even in a depression. It is a non-discretionary expense. 4. He is keeping energy. Chevron Occidental. Why? Because energy is physical. It is real. If the dollar crashes, oil goes up. If war breaks out, oil goes up. Energy is a hedge against the chaos. This is the roadmap. He is selling optimism, tech and banks, and keeping survival, energy and insurance, and hoarding optionality, cash. This isn't the portfolio of a man who thinks the law saved the economy. This is the portfolio of a man who thinks the law just broke the machine, and he is waiting to buy the parts for scrap. We have to mention the Buffett indicator as well. The ratio of total market cap to GDP is at historic highs. It is flashing red. The last time it was this high was before the dot-com crash and before the 2008 crash. Add the Supreme Court ruling to the mix, and you have a historically expensive market colliding with a historically weak executive branch. That is a recipe for a correction that isn't just 10%. It's 30%, 40%, 50%. The $382 billion isn't just a number. It is a scream. It is Buffett shouting across the canyon of time, "Get your house in order." The verdict is in. The White House has been crushed. The emergency powers are gone. The safety net has been cut. And Warren Buffett is standing on the sidelines with $382 billion watching. What should you do? The instinct is to deny it. To say, this will pass. The president will find a workaround. Maybe. But betting your financial future on a workaround against the Supreme Court is a fool's game. The law is slow, but it is heavy. It grinds everything to dust eventually. You need to look at your own portfolio today, not tomorrow. Today. Ask yourself, do I own companies that depend on government protection? Do I own companies that need low interest rates to survive? Do I have enough cash to survive a 12-month freeze in the economy? If the answer is no, you are vulnerable. You are standing in the path of the avalanche. This video isn't about fear. Fear paralyzes. This video is about preparation. Preparation liberates. Buffett is prepared. He has spent the last 12 quarters selling into the rally, building his fortress. He didn't time the exact day of the Supreme Court ruling, but he timed the cycle. He knew the cycle of executive overreach always ends in judicial pushback, and he knew that pushback causes pain. The pain is here. The law has spoken. The panic is silent, but it is real. Don't be the investor who reads the headline 6 months from now and says, "I wish I had known." You know now. The signal has been sent. The cash has been raised. The warning has been issued. The era of the magic wand is over. Welcome to the era of the hard reality. Good luck.